Silvergate, Silicon Valley Bank, Signature Bank, and now Credit Suisse. It seems like every other day, another bank goes up in flames. What's going on here? Why is this happening? The economy doesn't seem to be doing so badly. Unemployment is low, and people are spending money. Yes, the housing market is slowed because of higher mortgage rates, but it's not crashing, at least not yet. So why are these banks collapsing? And will there be more collapses? Sadly, the answer is yes. Credit Suisse's collapse is the largest yet in this banking crisis, but it's unlikely to be the last one. In fact, a new study out this week says that there are nearly 200 banks in the U.S. that are vulnerable to bank runs, like the ones that took out SVB and Credit Suisse. So what's behind it? The answer simply is inflation, and the efforts of central banks to get inflation under control. But to understand how we got here, we need to rewind back to the beginning of the COVID pandemic. Remember February of 2020? As COVID spread around the world and people began to realize that a major pandemic was unfolding, the stock markets crashed. Almost instantly, central banks stepped in and declared that they would support the markets and businesses through massive printing of money. The U.S. Federal Reserve led the way, just about doubling the supply of U.S. dollars through its quantitative easing program. But they weren't the only ones. The European Central Bank, the Bank of Japan, the Bank of England, and the central banks of most wealthy nations turned on their money printers like never before and flooded the global economy with new cash. It worked. Stock markets recovered from the crash of February 2020, but now there's a price to be paid. Economists have known for a long time that if you increase the supply of money without increasing the supply of goods and services to buy with that money, you will get inflation. Too much money chasing after too few goods. That is the classic definition of inflation. But central banks thought that this wouldn't happen this time around because of all the other things going on. Pandemic lockdowns forced businesses to shut down. People lost their jobs, and lockdowns meant even those who still had jobs couldn't spend their money. These things are deflationary. They cause prices to go down. Central banks thought that the deflationary pressure of the pandemic would be offset by the inflationary pressure of printing money, and you would get price stability. But they miscalculated badly. In essence, the central banks printed too much money, and by the second half of 2021, inflation was on the rise. The central banks were taken by surprise. They simply hadn't expected it, and as recently as late 2020, they were declaring there would not be an increase in inflation. But when inflation happened, they had to respond. And when inflation rises, central banks fight it by raising interest rates. Starting in early 2022, they did just that, raising interest rates at the fastest pace since the 1970s. They also put a halt to the money printing. What they were hoping for was an orderly decline in the inflation rate. As borrowing costs go up, it becomes harder for consumers to make major purchases like cars and houses, and harder for businesses to borrow money for new investments. This was supposed to lead to a slowdown in the economy, causing inflation to cool down. But what the central banks overlooked is the bond markets. Bonds are essentially IOUs on debt. Let's say you lend the government $100 for 10 years at a 1% interest rate. You get a bond that gives you the right to collect $1 in interest every year for 10 years. And at the end, the government pays you back the original $100. So the total value of that bond is $110. Once you've got that bond, you can sell it on the secondary market. Its total value is $110, so you can sell it to the bond market for just about that amount of money. But what happens when interest rates go up to, let's say, 4%? Now it becomes a lot harder to sell that bond. At 4% interest, lenders can go to the government and get a new $100 bond that pays $4 in interest every year for 10 years, and then pays out $100 at the end. So in other words, the new bonds being issued have a total value of $140. Who's going to buy your $110 bond when they can get a $140 bond for $100? In order to sell your bond, you have to discount it so that the buyer makes $40 over the 10 years. In other words, you have to sell that bond for $70. You bought it for $100, but now you can only get $70 for it in the market. And that is exactly what happened to bonds. Over the past 2 years, bonds have crashed by the largest amount in at least half a century. So what does this have to do with failing banks? Well, the reality is that banks are the largest holders of bonds. As you probably know, banks collect money from depositors and lend that money to borrowers. By law, they're required to hold reserves. They need to keep some of the percentage of the deposits on their books in the banks so they can pay out depositors when those depositors want to withdraw money. But they don't have to hold those reserves in cash. They can hold them in a number of different liquid assets, meaning assets that you can quickly sell and turn into cash when you need to. Government bonds are considered very liquid assets, so banks put a lot of their reserves into bonds, because with bonds, they can collect interest on those reserves. But starting in 2022, bonds experienced one of their worst crashes in history, thanks to rising interest rates. And those bonds on banks' books are worth less than their face value. Remember your $100 bond that can only be sold for $70? That's what bank reserves look like right now. The reality is that every bank is dealing with this problem right now, but for the most part, the problem is hidden because of the way banks are allowed to do their accounting. As long as they don't sell the bond, they don't have to admit its true market value. They are allowed to declare that they are holding the bond to maturity, that is, until the bond term ends and the government pays out the original amount. And that's all well and good, so long as the bank doesn't have to sell its bonds. But some banks are seeing its increased withdrawals, forcing them to sell their bonds and admit the reality that their reserves are far lower than what they look like on the books. Silvergate, the California bank that was the first domino to fall, was a major lender in the crypto market. Last year's crash in crypto prices meant that many crypto companies had to withdraw their money from their bank accounts. Just like a person who loses their job has to draw down their savings to live, so too did these companies have to draw down their savings to keep operating. It was a similar story with Silicon Valley Bank. It was a major lender to California's tech companies, and starting last year, we saw a major bust-out in tech stocks. Companies like Amazon, Meta, and Alphabet took a large tumble. And today, we're seeing these companies announcing major layoffs. Tech companies' deposits in Silicon Valley Bank began to shrink, and at a certain point, it became obvious that SVB wouldn't have the money to cover those withdrawals. When word spread about its financial problems, depositors at SVB began to pull out all their money, a classic case of a bank run. It's a similar story with Credit Suisse, although it's a much larger bank. The collapse of Credit Suisse is one of the worst bank failures in human history. Its problems actually began much earlier than SVB's, and they weren't limited to the bond market. In recent years, Credit Suisse has developed a reputation for shady dealings. It was convicted of allowing money laundering for drug dealers in Bulgaria. It was involved in the bankruptcy of Lex Greensill, the Australian financier whose Greensill Capital was accused of criminal activity before it went belly up. It was one of the biggest creditors to Archegos Capital Management, the now bankrupt asset management company, despite the fact that its predecessor, Tiger Cub, had already been charged with insider trading by the Chinese government. Over the past 5 years, Credit Suisse's stock price dropped by nearly 95%. Then came the bond market rout. By late 2022, Credit Suisse was undergoing a bank run, with tens of billions of deposits being pulled out. The Saudi National Bank came to the rescue, injecting fresh capital into the bank to keep it afloat. But when SVB collapsed a few weeks ago and depositors became nervous, the trouble started up again for Credit Suisse. This time, the Saudis said they wouldn't inject any more money into the bank, and a full-on bank run was underway. On Sunday, the Swiss National Bank came to the rescue, promising a $100 billion lifeline for the bank. And the Swiss government essentially strong-armed the other giant Swiss bank, UBS, into buying Credit Suisse for about $3 billion, or half of its market value as of Friday's stock market close. On Monday, stock markets reacted appropriately. Credit Suisse shares fell by half. But the Swiss did something else that is making bank investors very nervous. By forcing the sale of Credit Suisse to UBS, they ensured that Credit Suisse shareholders would get UBS shares and wouldn't lose all their money. But they did the opposite for Credit Suisse's lenders. They declared that the bank's $17 billion of Tier 1 bonds, essentially $17 billion of money lent to Credit Suisse, were now worthless. The lenders who gave that money to Credit Suisse will not get one penny back. That's exactly the opposite of how it normally works. When a business goes belly up, usually the creditors who lent it money get paid back first, and the shareholders get stuck with the worthless stock. And now lenders to banks all around the world are wondering if they are holding worthless bonds too. They well could be. The bond market crash has left countless banks with depleted reserves. A new study published on the Social Science Research Network estimates that there are 186 banks in the U.S. that would not be able to survive if half their deposits were taken out. And that's just the U.S. alone. Banks in Europe and Asia are also under pressure following the collapse of SVB and Credit Suisse. Attention is now turning to Germany's Deutsche Bank and Italy's UniCredit as two banks that could potentially face problems in the near future. So what does all this mean? Well, for one, it's possible that the Fed and other central banks are going to hit the brakes on further interest rate hikes and maybe even reverse course and start lowering rates. But the central banks haven't achieved what they wanted to with interest rate hikes. Inflation is still running hot. So if they stop now, they might prevent some banks from going under, but at the cost of even more inflation in the years to come. And it probably means more money printing, which the Fed said it was going to stop doing. But in the wake of SVB's collapse, the Fed has already printed $300 billion to backstop banks in trouble. And its new backstop for banks gives it room to print. And get this, another $2 trillion. If they do that, you can bet your bottom dollar inflation will be running hot. And if inflation accelerates again, then the Fed and the other central banks will be under pressure again to raise interest rates, which will again sink banks into deeper trouble. So there really is no easy way out of this. The real solution would be to go back in time and stop the central banks from printing so much money in the first place. But since we can't do that, we aren't going to escape paying the piper in the years to come. Buckle up. It's going to be a wild ride.